Welcome to Perspectives from HSBC. Thanks for joining us. And now, on to today's show.
Hello, I'm Zoë Knight. I'm the Global Head of Sustainability Research and Integration at HSBC Global Research. And I'm joined today by Sir Danny Alexander, the CEO of our HSBC Infrastructure Finance and Sustainability team, and Eric Francia, the CEO and President of ACEN Corporation. So today we're going to cover several topics around the opportunities and risks relating to sustainable infrastructure. So I'm going to kick off with a question to you, Danny, which is really, what is the role of sustainable infrastructure and what is the opportunity in this space?
Well, firstly, Zoe, thanks for having me for this podcast. Sustainable infrastructure is a huge opportunity. If you think about the needs in the world towards the net zero transition, we're talking about trillions of dollars per year, maybe $5 trillion per year globally by 2030. And that's across a range of sectors, mainly energy related, clean energy, power grids and distribution systems, energy storage, but also green transportation, electric vehicles, across the range of areas. When you look at the analysis of the net zero transition, actually about 80 to 90% of the investment needed worldwide to achieve net zero by 2050 is infrastructure of one kind or another. And then, of course, there are other drivers. You look at the digital transformation, investment in data centers, and the power needs there. So rather than global electricity consumption growing steadily, we're seeing a much faster increase driven by technology, driven by needs of development, especially in the developing world. And so sustainable infrastructure will help us to make sure that the power that's generated to meet those needs is clean, it's sustainable, and increasingly it's the cheapest form of power generation around as well.
Well, that's certainly a massive opportunity in the trillions. Eric, are there any other benefits that we see as well as the pure investment potential?
Well, to state the obvious, the multiplier effect of those trillions of dollars. In the case of the Philippines, our home market, the Department of Energy estimates that the country would need around $500 billion orders of magnitude in the next 2 decades to enable a successful energy transition. And you could imagine that's already the size of the banking assets today.
Gosh.
Right. So it just goes to show that we need to tap international funding as well over time. So, but apart from the obvious economic multiplier impact, which is quite significant, I think the job creation is also significant. Those green jobs, there's estimates out there that put it at around more than 30 jobs created per megawatt. And we're talking about a few thousand megawatts per year that we need in a country like Philippines. But, we span across the region as well. Our company ACEN is also in Vietnam, Laos, Indonesia, Australia, India. So, and again, we typically build around 1,000 megawatts per year. We're now at 7,000 megawatts and counting. So you can imagine the job impact as well. So it goes beyond just providing clean electricity, goes beyond the multiplier effect, but also goes deep into the community and the social impact.
I think this point you're touching on about the people impact is a really important one. One of the pieces of work that we're doing at HSBC is looking at how the net zero transition will be delivered and the value disruption linked to this. And without bringing people along, it's really difficult to make the transition at the speed that is necessary to help us with our climate goals. So it's really useful to hear you talk about that. Danny, is there another way of thinking about how we finance the transition? I mean, so far companies have been sort of setting targets for financing. How is this financing metric evolving into thinking about the old fossil to new clean funding requirements?
One of the ideas that's emerging is about the ratio between your clean investments and investment in other older energy sectors, and that ratio measures, in a sense, how much you're doing in the new sectors that are emerging, and so I think has the effect of incentivizing more financing, right? for HSBC Infrastructure Finance, the business that I lead, we have plans to substantially increase our investment in infrastructure, and especially investment in infrastructure related to the net zero transition, renewable energy, storage, EVs, also some of the emerging sectors. So I think it's another benefit of this transition, that it's also incentivizing innovation. I think it's encouraging the speed of innovation and the speed by which new innovations are brought to maturity and then scaled across the market to be much faster. And so I think that financial institutions like HSBC, we have a strong commitment in this space, but in a sense, we need to really now step up our efforts to see this as a crucial commercial opportunity, as well as one that's around kind of policy commitments and measurements.
That makes a lot of sense, because we know that the volume of capital requirement is huge, and we've known about the climate problem and what to do about the climate problem for a long time, but we're just not moving at the pace that's required. So what really are the risks in terms of project delivery, and what sort of barriers have you seen in this space, Eric, in terms of the practicalities of how ACEN is working?
Well, there's quite a few, right? Number one is the policy. It really differs by market, by region, and so forth. But at a broader level, policies emanating from the United States, just to make it very current, do have some impact. Not a great deal, but elevated interest rates do create some headwinds for the rollout of renewables, given that 90% of the levelized cost of electricity of renewables is really capex related, right? Because it's zero fuel. So mostly it's capex and a little bit of opex. So we're very sensitive to the cost of capital and the sort of liquidity of the financial markets. There's also infrastructure, or the lack thereof, right? This energy transition is very demanding in terms of upgrading our grid infrastructure that Danny mentioned earlier. And it's not easy, right? You've got right-of-way issues. You've got the NIMBY mentality, the not in my backyard. So it's not as easy to build new lines, new transmission lines, or upgrade them, because you'll really need to earn your social acceptance and public support. When Danny was discussing the capital requirements and the ratios, one thing that came to mind is actually, if on a like-for-like basis, we're focused now on renewables as a company, and we're building something that would be equivalent to a mid-merit gas plant, like 12 hours a day as opposed to 24 hours a day. So this is a combination of solar and battery storage. The investment for, let's say, a 400 megawatt renewable and storage plant is about $1.5 billion. The equivalent of a 400 megawatt gas plant is less than half. But it's not because gas is cheaper. The capex is cheaper, but then you need to buy the fuel.
Yeah, the lifetime costs now for the renewable option are often cheaper, right?
Yeah, versus gas.
But it's the big investment up front that needs to be taken care of.
That's correct. Yeah. That's correct. And the again, it's like crystal balling, because the perennial debate is renewables already as competitive versus fossil fuel. I think we tend to oversimplify that. When the sun is shining, it is cheaper, but it's an unfair comparison. If it's not shining, you have to make it more reliable, dispatchable, and so forth. Once you put in the transmission infrastructure and the storage and so forth, you could argue it depends. It depends on where the gas price and coal price is. But the thing is, at least you're assured of energy security because you are harnessing indigenous resource. People harnessing indigenous resource is invaluable, and I think that's one of the strongest propositions of renewable energy as well.
I think one of the points that you made earlier around uncertainty and making sure that there's an enforcement mechanism to make sure that the mechanism is implemented is really important, because we've had experience in the past where investors have been burnt because of a pullback of subsidization of renewables in Europe, and that does create uncertainty. Investors do have long memories, and it's really important to keep up that sort of that guidance and that direction, that the certainty and the policy that is going to play out the way that investors expect.
Absolutely.
So it's a tough one. Danny, From your previous roles, is there anything that you can tell us about the barriers to project finance in emerging markets, for example, in terms of areas that are holding us back?
So before coming to HSBC, I was with the Asian Infrastructure Investment Bank, which is a multilateral development bank. So public money goes in there. And one of the things we saw there, and I think it links very much to what Eric was saying about policy regimes, that you can even look around ASEAN, you can see very different policy regimes in different countries, and as a result, the market is much more or less developed. And one of the things I developed at AIB before I moved on was a new instrument for them called climate policy-based financing, where the notion would be to finance the government in exchange for the policy reforms that would be necessary to create the stability of firstly the quality of regulation, and secondly the stability of regulation that is necessary to help the private sector. Because for the public resources that those institutions have, of course you can do blended finance on a project by project basis. That can be very valuable sometimes. But actually, if you can help to reform the system, then that can make a big difference. Before going there, I was a minister in the British government. I was part of designing the regulatory regime for offshore wind in the UK, which was a balance between giving clear incentives to investment whilst also trying to regulate the impact on consumers' bills. And actually, it was extremely successful. After I left office, we saw a huge increase in offshore wind investment in the UK. HSBC has then supported a lot of those projects over the years. And it's a good example where if you get the regulatory framework right, and of course the stability that Eric talks about, then that can make a big difference to private investors. I mean, I also think that we do see a lot of political noise around some of these issues. And I think that in a sense, we have to look through the noise to both the scale of the opportunity globally, but also I think to move this from being something which is really a political talking point to being considered primarily as a commercial opportunity.
What can we do to go faster? What are the solutions looking like to unblock these niggles that we have in terms of driving this forward? Danny, if I may continue with you for a second, what's HSBC doing to catalyse this transition? What have we got in place that helps us move this forward?
Well, to start with, we're scaling up our infrastructure finance business with this in mind. So we'll be providing more finance to more infrastructure deals around the world. And I think that HSBC is very well set up for this agenda, because if you look at the markets where we're strongest, here in Asia, in the Middle East, where we have an amazing presence dating back 160 years in some cases, then that's where the investment is needed most. It's where you see the growth in electricity demand. It's where you see the need for energy transition and the opportunities for clean energy to be strongest. And then a lot of it is happening across the corridors, Asia, Middle East corridors, within Asia, where again HSBC is kind of uniquely well positioned. But in addition to that, we're also building platforms to help mobilize investment. So I think blended finance is going to be very important in some markets. We've worked with our partners in Temasek to create a platform called Pentagreen. That's now mobilizing finance from a number of development finance institutions, where the focus is really on what we call marginally bankable projects. In other words, projects that maybe just have a few things that need to be fixed to get them to the point where they can be financeable. And so this blended finance platform should bring a lot more projects across ASEAN and South Asia, a lot more projects forward that can then be bankable in the private sector.
Well, there's a lot of work going on there. Eric, what about any innovative mechanisms that you've come across ASEAN in the work that you're doing?
Yes, absolutely, including innovations in financing. We at ACEN have supported the pioneering work on early coal retirement, which could be a controversial topic. I often get asked, why retire a coal plant when the country is growing strongly in terms of electricity demand, right? especially in this part of the world. Now, the thing is, we are well behind our climate targets, and it's easy to make an excuse that in Asia, which by the way accounts for around 80% of the coal plants globally, between China, India, and Southeast Asia. That's where the bulk of it is. And coal plants account for about 20% of global emissions, right? So we need to do something about it, and it's not in our DNA to just say it's not our problem, and therefore we'll continue business as usual. Now, it does require some support, and there is some intent and underwriting that's already been announced with the Just Energy Transition Programs, JETP. The ADB, Asian Development Bank, pioneered, pushed for the concept of energy transition mechanism as an innovative mechanism that entails the leveraging of low-cost, purpose-driven financing to enable the buyout of coal plants with a purpose of shutting down coal plants earlier than their technical life. We love the concept because as ACEN shifted from a fossil fuel-focused company in our first 5-6 years of existence, that was 2011 to 2016, we made the pivot in 2017 to start divesting our coal plants and basically go all in on renewables and go beyond the Philippines as well. So inspired by ADB's ETM, we said, look, we think this can be done. Even onshore, because it's a modest-sized coal plant that we're shutting down through this mechanism. It's 246 megawatts in the Philippines. We were supported by both banks and insurance companies, both on the debt and equity side, and we made it happen. So we closed the world's first market-based energy transition mechanism in November 2022. It didn't entail any subsidy. It's really a smart financing mechanism where we divested the coal plant, but we as the sponsor, ACEN, committed to enable the shutdown of the coal plant after 25 years of operations, which is in 2040. Right? Coal plants typically last for 40, 50 years. But we got financing for that, and we were able to recycle the capital into renewables. Now we're being more bold because the ADB encouraged us to accelerate further from 2040 to 2030. Why? Because if we are to meet our 1.5 degrees target, half of the world's coal plants need to be shut down between 2022 and 2030. A daunting task, mission impossible, but challenge accepted. So we said, but we need another mechanism. The ETM will not work to further accelerate that by 10 years, shutting down a coal plant at year 15. And this is where the notion of carbon credits or transition credits, which is a high integrity form of carbon credits, and this is being pushed or led by no less than the Monetary Authority of Singapore and the Rockefeller Foundation, banded together and selected our project to be the world's first pilot project for transition credits. It's exciting new space. It will be done under Article 6, which is also relatively new. But I believe that there is a huge opportunity in terms of the international cooperation using Article 6 framework to ensure high integrity, high quality projects, because integrity is now a key question on carbon markets, right? But with credible institutions like MAS, I think and under Article 6, I think it's exciting. We're learning a lot, so we're hoping that we could have a proof of concept that this can work, this early coal retirement, and that it can be replicated and scaled up as well.
That's particularly interesting. And so for those of our listeners that are maybe not as close as we are to the Paris Agreement,
Yes.
Article 6 is the mechanism about carbon credits and how countries can use them
Yes.
in terms of trading
Correct.
for their to meet their climate goals.
Thank you for elaborating. That was well synthesized.
I think it's really impressive, the leadership that you've shown in that area. And I mean, precisely to your point, we have to create scalable mechanisms that enable that to happen, as you said, in a high integrity way. One-off transactions help to prove the concept,
Yes.
but to get to the scale that's needed, transition credits is an important idea. The contribution that ADB is making is with their development finance is also very relevant here. And I think it's, when I look at this agenda, you always feel this combination. You go to COP meetings, you come away feeling both a little bit pessimistic because you see that the progress the world is making is not fast enough to meet the goals that have been set in the Paris Agreement. But I also come away feeling very optimistic because of the amount of innovation that's going on, the new companies, the new ideas that are being developed, the scale at which and the pace at which financing is being ramped up, deployment of transition technologies, renewables and so forth is being ramped up. But I do think that what's important here is to see this issue increasingly through the lens of the commercial opportunity, and that we take steps to put the right policy frameworks in place in markets where those aren't as optimal as it could be. We work much more effectively across public and private sectors where blended finance is needed, and that we understand better the real risks of these projects, but also the risk of not doing anything. And I think that way we can really see the commercial finance scaling up. I think one of the areas where innovation is needed, and this is a focus for us at HSBC, is about increasing the velocity of circulation of our capital. You know, there are large pools of capital out there that want to hold infrastructure assets, performing assets for the long term. And so what we need to do with our capital is support the creation of new assets, lend through the construction period and so forth, but then distribute those assets to other partners. And that's an issue not just for HSBC, I think it's an issue for the whole transition. You know, the faster capital can circulate back to the next project, and those assets can be handed on to people who want to be stewards of them for the long term, the better. And that's something that we're working on, international institutions are working on, and I believe it's a critical part of the solution to this problem.
That's a very interesting way of thinking about the speed of capital circulation. Eric, what does success look like for you in the next 5 years and the company?
I think from our point of view, Zoe, it's about staying the course and continue to do what we all do best. It's so easy to get lost these days with all the noise, and I think it's critical that we separate the noise from the fundamentals. The fundamental truth in my book is that the energy transition is an underlying mega trend, sustainable trend. It's irreversible. So I think bottom line is there has to be companies that should remain steadfast. Maybe we finesse the trajectory, be more realistic, but to me what's important is we talk less and we do more at the end of the day.
That's an incredibly good note to end on. So I'd just like to say a heartfelt thank you to both of you for joining us here today, and I look forward to seeing what happens in the future.
Thank you for joining us for this episode of Perspectives. Make sure you're subscribed to HSBC Global Viewpoint to stay connected